Hi, I'm Bill Pieroni, President and CEO of ACORD. For the last 50 years, ACORD has served as the global standard-setting body for the insurance industry. We have 36,000 members across 100 countries, representing half of the world's written premium. We are enabled by support and participation of industry stakeholders, and Benefitfocus has been a strong supporter of ACORD through standards donations, advocacy, and a sponsor of research. Today's presentation on the digital customer experience in health insurance is one of the studies sponsored by Benefitfocus. It's a first-of-a-kind study which examined over 2,400 websites and platforms and generated over 60,000 impressions. The study identified superior customer experience and corresponding strategies, operating models, and capability imperatives. Insights into successful development and delivery of winning experiences through leveraging digital platforms are highlighted in today's study. The scope of the study looked at 2,400 insurer websites, gathering 60,000 impressions over the last 10 years, identifying strategies, tactics, and outcomes. The team examined filings, presentations, reports, third-party and governmental analyses, conducted interviews and research, but most importantly, proprietary research and evaluations of each of the individual websites. Three key findings. First, there's a dramatically changing consumer, investor, and regulatory landscape surrounding the health insurance industry, driving the leverage of health insurance platforms. Next, and we'll talk more about this, automatic approach ascendance is increasing at an increasing rate in terms of platform business models. And lastly, it's critical for health insurers to align their platform strategic intent with the marketplace realities and capabilities. We looked at 2009 to 2019 non-claims insurance expense. So the base year was 2009, indicated by the 100, 100, 100, 100 for health, life, home, and auto. And as you see, from 2009 to 2019, health insurance non-claims expense rose 18%. So that's non-indemnification, it's the underwriting, the general expense, the acquisition expense, everything but claims. And when you look to other lines of insurance like life, home, and auto, each of those lines saw a real and nominal decrease in the percent of premiums being spent on non-claims capabilities. Clearly, health insurers are one of the few insurance lines of business that have seen non-claims expense steadily increase as a percent of premium over the time frame. Just to ensure that it wasn't just an insurance phenomena, we created a composite of other industries, including healthcare, industrials, technology, and real estate. And here we found that while those companies don't have claims or non-claims expense, but they have operating expense, we saw an even more dramatic decrease in expenses from an operating expense standpoint, which is comparable to the non-claims expense. So clearly, other lines of business within the insurance sector, as well as non-insurance firms, have achieved material operating improvements year over year over the last decade. Now, when we look at household insurance spending in the United States over the same time period, you'll see that auto is down materially in nominal terms, while life and home are up marginally. But again, health insurance as a percent of household spend steadily increased over this time period, up over 77% on an index basis. So clearly there's something going on here in the health insurance space that we don't necessarily see with life, home, and auto lines. Clearly, we believe at ACORD there's a significant opportunity to optimize health insurance operations. Next, it's our hypothesis that operating expenses are underlying that increased household spend on a percentage basis. And really, this was the genesis of the study we're about to engage in, but platforms are the key enabler of improved operating economics. Now, I mentioned at the onset that Benefitfocus was the sponsor of this study. It's an incredibly lengthy study. We only have time today for about 20 minutes of the study, but we pulled out key slides that we thought were most impactful. Now, when you look at the S&P 500 over the last 10 years, that first number, 100, represents 100% of the market capitalization of the S&P 500. So all 500 firms in the S&P 500 represent 100%, and we indexed it to say that's their total shareholder returns, the 1.00. Total shareholder returns are represented by real share price appreciation plus dividends. Now, when we take the S&P 500, we divided them in the top 12 and the rest of the S&P, so 488. Now, amongst the top 12 firms on the S&P 500, they represented nearly 32% of all of the S&P 500's market capitalization, even though they're only 12 out of 500. And those top 12 firms had over a 2.1x return, so nearly twice as much, over twice as much as the S&P. And when you look to the rest of the S&P, the 488, they represented 68.3% of all the market capitalization, and they had a return slightly less than the average. So from a size standpoint, we see that smaller cap stocks, not even small cap, but those outside the top 12, actually had about the same return, while the top 12 really outperformed. We then looked at, among the top 12, in terms of market capitalization, who had no platform strategy? And about 1.1% of the total market cap out of the S&P 500 in the top 12 had no platform strategy. Those firms have about half the total shareholder returns. We then looked at those firms who viewed platforms as an option. They leveraged third parties, limited scale and scope, but at least they were participating in platforms. Now, they represented 4.1% of the market cap, and they also had a little better than half of the average return. The third group out of the S&P 500 in the top 12 were those that had platform-centric business models, an explicit strategic intent and set of core capabilities, resource allocations towards platform, more importantly, leadership and management focused on platforms. Now, those firms represented over 26% of the market cap and had nearly a 3x return. Clearly, platform-centric business models in and of themselves, when looking at total shareholder returns amongst the S&P 500, have a material impact overall. There is a strong correlation between platform-centric business models and value creation. Now, when you look at business strategies, a lot of firms agonize and spend a great deal of time, money, and management and leadership talent trying to understand what their strategy should be. There's only four. You can compete on price. A nicer way would be saying you're competing on operational excellence. In other words, your value proposition is a lower price. Next, customer centricity. I know you better than any other firm. I deliver a tailored experience. I have tailored value propositions towards you as an individual, so things like mass customization are involved there. Next, I compete based on product. My product is unlike anyone else's. It's truly unique. And lastly here, innovation. I deliver an innovative product, price, experience, channel, distribution strategy, whatever it may be. Now, there's two other strategies. There are those situations where it's unclear. It's hard to tell. And there are those where it's a composite. Now, composite is a recent phenomena that we at ACORD have uncovered over the last 5 years. Increasingly, technology like platforms support the ability to no longer focus on one dimension of strategic intent, but rather simultaneously execute against at least two or more, right? The historical trade-offs between price and product and innovation and customer seem to be blurring based on technology. Well, when you look at those 5 options, clearly no strategy or an unclear strategy is not one we examined. But when you look at price, customer, product, and innovation, and you look across key components of the health insurance value chain, you'll see, depending upon your strategy, various parts of the value chain matter, right? So marketing, everybody has to have strong sales and distribution capabilities. Underwriting tends to matter more around price, product, innovation, as well as composite. Service and claims vary. The one ubiquitous factor we found is that regardless of your strategic intent, We believe that over the long term, composite strategies will be the winning strategy. But regardless of whether you're a price competitor, customer segment dominator, product differentiation strategy, or innovator, platforms play a key role. Now, this page tries to look at the historical trade-off that went on between operational efficiency on the x-axis and willingness to pay on the y. So looking all the way at the end of that operational efficiency x-axis, you'll see price. So if you're going to compete on price, well, it's almost axiomatic. Customers aren't necessarily willing to pay. By definition, you're paying a cheaper price. As you move away from price competition, you perhaps don't need to be as operationally efficient, and it's harder to be on a relative basis operationally efficient. When you're innovative, product moves you up that Pareto curve a bit, and customer. You can see that the highest willingness to pay is when you have a strategy that focuses on a discrete customer segment. Our data shows that carriers, insurers who compete based on customer centricity have a higher willingness to pay. However, it's expensive to customize on that level. And it's a little less expensive to compete on product. And it's a little less expensive to be innovative, and clearly a price strategy is one where you're completely efficient. So think about this efficiency trade-off between how efficient can you be and how can you get a customer willing to pay more for insurance. One of the exciting things about platforms in our analysis is that composite strategies, which look at all of them, are really enabled by platforms. Leveraging a platform enables carriers to simultaneously increase efficiency, pushing it out, and increasing customer willingness to pay. And we'll spend some time talking about our findings and why this is true. Now, when you think about the legacy context of a health insurer versus platforms, the focus for legacies tend to be standard product. Platforms really enable you to deliver and craft tailored solutions. Structure. Legacy models tended to be based on rigid value chains. Platforms, interactive value webs. Positioning. Historically, health insurers attempted market dominance. That could have been for a segment, within a geography, within a type of offering. Platforms really allow health insurers to position themselves for valuable share. So not just scale and scope dominance, but really, where is the profitable share where you can have a differentiated source of advantage? Partnerships. Historically, partnerships in the health insurance space tended to be relatively static and last for a decade or more. In platforms, they're far more dynamic, lower barriers to entry and barriers to exit, and they are oftentimes 3 to 5 years in terms of length. Value proposition, traditional to expanded. Platforms dramatically enhance a health insurer's ability to offer services and capabilities that legacy platforms or channels didn't lend themselves to. Value division. Historically, it tended to be unit-based for brokers, agents, and channels, and paid at renewal. Platforms really are about impact and continuous forms of value division. And lastly here, value capture. Historically, health insurers capture value through operational scale and scope economies. Platforms really enable the next generation of value capture through informational scale and scope economy. The ability to know more about customers, markets, channels, geographies, and use that data to craft and deliver superior value propositions. Now, I think everyone on today's webcast will know this, but it's worth saying. In surveying customers in the United States, health insurance is the #1 category required on platforms. Now, I'm surprised it's not higher, but clearly it's the leader. Consumers in the US looking at platforms, 88% have it ranked as #1 in terms of the product they need to see. Now, when you ask those same consumers, what matters most to you? Well, on an index basis, choice shows up. Interestingly, inexpensive or price shows up last. Now, our behavior-based data shows that price really is the #1 choice. But, you know, it could be that they don't explicitly recognize that. They don't want to admit it to themselves from a consumer standpoint. one of the things that we uncovered is that composite strategy allow you to hit each one of these customer imperatives. Now, when I think about platforms really, as we spoke about, allow you to deal with choice, convenience, access, information, connection, and price in a single platform. We hypothesize that there's another factor that consumers don't even mention, and it's the fear, uncertainty, and doubt associated with pick. Our data shows that if given the choice to make no choice in the health insurance space, consumers will in fact make no choice. If given the choice to not change where they're currently at, they will remain where they're at. So we think an unspoken customer imperative is, how do we address that real and perceived risk? And again, platforms on a global basis seem to deal with that and are uniquely positioned to help to deal with not only everything through choice, through price, but also that fear and uncertainty in making the wrong choice around this incredibly important decision. Now, this study focused on pre-shopping stages. So before you even get into the consideration set, what goes on in between being completely unaware of your individual firm, or what a PPO, a POS, an HMO is, all the way to how do I then shop? We still have the shopper is yellow because they aren't a buyer yet. Now, in between being unaware of what's going on and shopping, there's a series of steps that we examined. And again, we don't have time today to go through them, but there's awareness. Now, when you become aware of a product or a brand, you can remove that product or brand from the consideration set. Those are the red shoppers going down. And some don't want to continue on a platform or an online basis, and essentially they've showroomed and they may contact the carrier in an offline type of situation. Then there's that visit to learn, the insight, the learning part, and then the development of the intent. So you haven't bought yet. This is the shopping intent. And we spent a great deal of time here trying to understand when do carriers drop out of the consideration set, when are they showroomed, and when do consumers move through the platform. Now, clearly platforms, indicated by this yellow shape here, bring together insurers and insureds. And we sought out as part of our analysis to identify what causes a customer to engage, identify the product, the insurer, and then continue to shop. And the three key questions were, why do they engage? Why do they come to a platform, right? It could be everything from as simple as the employer has engaged with the platform, or search engine optimization, word of mouth, friends, billboard advertising. We studied it endlessly. Next, how do members screen solutions as they try to narrow down the choice? And lastly, what solutions are ultimately selected for shopping as they move beyond this shopping part to the actual buying? Now, we took a very insurer-centric perspective, and we recognize at ACORD, if you've seen one insurer, you've seen one. Clearly, there are healthcare service corporations and mutuals and for-profits, non-for-profits, publicly traded, private, but we tried to develop insights that would be relevant across the health insurer continuum. Now, we identified 5 types of platforms, along with member alignment. So it doesn't mean that there aren't customers who are more sophisticated buying from buy what we have platforms, but these represent the ideal pairing. So the first type of platform is, look, you buy what we have. These are the products we have. They tend to work best for members who don't know what they want or don't know what they need. There are then platforms who respond to your desire. Now, those are customers who have limited knowledge. So they have some knowledge though, but it attempts to respond. The next, a curated offering, increasing levels of sophistication. So the platform here takes the health insurance product and curates it, tailors it a bit. The next stage, the member really has some inertia and some biases. So the solution is aligned to deal with those inertia and biases to help the member pick the right product for their family. And lastly, the ultimate one, automatic execution. Now, it may seem counterintuitive. The customer knows what they want. They're predictable. So it isn't as if you're just responding or giving them what you have, but you really understand it almost a priori in real time so that you can really offer that up and reduce the search costs and help to deal with that fear, uncertainty, and doubt we spoke about. Now, the trigger for the first three, it tends to be the customer. Now, for the last two, the aligned solution and the automatic execution, the platform really triggers it, either through a life event or another exogenous or endogenous factor. Interaction. Well, it moves everything from need-based to episodic to proactive. Again, automatic execution, it's platform-driven and proactive. Effort, relatively high effort for the buy what we have. It may be counterintuitive that there's a limited choice, but there's a high perceived effort on the part of the member who's shopping for it because they have to really educate themselves and deal with some of that dissonance. Moderate in the middle, but automatic execution really dramatically reduces the overall effort, despite the fact that there may be more of a choice than the first offering. Preference. First two expressed by the customer, curated offerings and recommendation, aligned solutions educate, but automatic execution is autonomous. It's part of the experience. And in terms of insight, limited amount of consumer or shopper insight in the buy what we have and respond desire, adequate for curated, but the real data and insight around shaping that offering and learning by doing goes on within the aligned solution automatic execution platforms from a health insurer perspective. Now, when you think about platform maturity, right, clearly the buy what we have tend to drive limited value for consumer and insurer value. That's the y-axis. Platform maturity is relatively low. And as we move along this curve, right, as you get to this automatic execution, what platforms in this space are really trying to do is continually sharpen the saw, optimize what they're doing on an ongoing basis. Now, from a health insurer standpoint, we would encourage you at ACORD to avoid traditional linear evolution. If there are opportunities to partner with platforms who really help with that automatic execution, you can generate faster and more diverse insight. And again, as you saw earlier, we believe that informational scale and scope economies will be a key source of differentiated advantage. These types of platforms help you to create and deliver differentiated value. And it's critical that you as organizations generate and cultivate strategic flexibility and operating adaptability. Now let's look a bit to those critical success factors for automatic execution. Well, platforms who help to automatically execute help you as an insurer to identify those insurers uniquely, help you to differentiate your value proposition solution by the needs and the value that the consumer places on it. And you're part of that virtuous cycle of interacting so that you learn and confirm over time what the consumer wants. And at the center of it really is, it enables you to customize not only the experience, but more importantly, the solution. But there is some critical success factors from the carrier standpoint that we found in doing the study globally. First, there's two types of change: decision-based change your logo, change the color of the font you use in your marketing material. But then there's behavior-based change. Getting colleagues within your organization to change their behaviors to fully embrace platforms is a very difficult thing. And we as an industry don't do a very good job at change. In fact, within the insurance space, more than 2/3 of change efforts fail to deliver against their scope, time, and resource constraints. That's an entirely other study that we developed at ACORD, but we're not very good at change. Next, it's really important to look at the cost of inaction and consider the option value through embracing platforms. Now, many times we as an industry tend to be very conservative, right? We don't like acting, but in not acting, yes, information can be gathered and we can learn, but there's a cost there. You're not learning, you're not acting, and you're also not generating that option value so that you're engaged in it. We think it's very important that you engage early on in platforms. And lastly, as Peter Drucker said, incremental change is oxymoronic. Doing platforms well really does involve transformational change, and that's something that we as an industry are not all that comfortable with. But I think incrementally experimenting here probably doesn't position your organization as best as it can to be fully engaged and learning on how to deal with the future inevitability of platforms. I'd like to end with looking at customer lifetime value, traditional versus platform. So all of us hopefully understand customer lifetime value over time. Customer lifetime value is just the present value of all the future free cash flow that an insured can generate. Well, when you think about the curve, during the awareness stage, we have to spend money as a carrier to make customers aware of what we've got, and that creates a marketing deficit. And then there's acquisition cost, that underwriting cost, and you begin to collect premium and it begins to get positive. And on a post-purchase basis, you retain the customer, you cross-sell them, and you manage the relationship, and you're part of that virtuous cycle that we spoke about. The most powerful thing that platforms do for economics is it completely changes these economics. When you look at what platforms do, they're able to dramatically reduce, if not eliminate, that value gap in between awareness to post-purchase by reducing the acquisition economics, by enabling you to tailor, by giving you data real time to use so that you're profitable and generating value from nearly the onset of the customer relationship. Incredibly powerful insight. Clearly, the study supports the importance of platforms as part of a winning and differentiated strategy. Platforms are critical to address our current economic reality as well as emerging customer expectations. Again, we didn't have time to go into the entire study that Benefitfocus sponsored, but for more information, please visit us at www.accord.org/research or contact us at research@accord.org. Again, I can't thank Benefitfocus enough for their support and sponsorship of the study. Thank you all for taking the time today.